So, you've heard about the stock market, and now you want to invest in it. Maybe a friend of yours showed you that he's making some money off the stock market. Maybe you've heard about Warren Buffett, who's made $86 billion. Yes, billion, with a B, off the stock market. Or maybe you're just looking for another way to make some extra money. Whatever the case might be, I'm here to teach you what the stock market is and how you can invest in it. Let's go. So, what really is the stock market? Well, to answer this question, let's see what Investopedia has to say. And if you are a beginner, if you are a new investor, Investopedia is going to be your best friend. So, Investopedia says, in the first sentence, the stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. So, what does this mean? Well, the stock market is actually what you call the agglomeration or the group of all the stock exchanges in the world, where in these stock exchanges is actually where you buy, sell, or issue new shares, and I'll explain shares in a minute. But the stock market is actually the agglomeration of all these stock exchanges, and there are many stock exchanges. For example, in America there's the NYSE, New York Stock Exchange, there's the Nasdaq, which means National Association of Securities Dealers Automated Quotations. Let's stick to Nasdaq. There's also the London Stock Exchange, the Euronext Paris, I believe, the Tokyo Stock Exchange, the Shanghai Stock Exchange, so you get the point, there's a lot of stock exchanges in the world. Now, does this mean that every company is in one of these stock exchanges? Not at all. There are public and private companies. Public companies are already in these stock exchanges and you can buy and sell shares, while private companies, they are not listed in the stock exchanges, and they can only become listed in them through an IPO, an initial public offering. And after this IPO, you will be able eventually to trade, buy or sell, which is trading, shares of this company. But now you ask, what is a share? Well, let's illustrate. Imagine a puzzle with 5,000 pieces, and the 5,000 pieces put together forms the entire puzzle. The entire puzzle is a company. And imagine that each piece of the puzzle is held by a different person. Well, each piece of the puzzle represents a share. So holding a piece of the puzzle is the same as holding a share of a company. So now you're thinking to yourself, oh, really, me, I can own a piece of Apple, I can own a piece of Google, I can own a piece of Amazon? But wait, how can I buy a share? Well, that's where a broker comes in. A broker will link you to the stock market. Imagine a broker as being the middleman between you and the stock market. When choosing a broker, you always have to take in consideration what are the fees they charge for trading, for buying and selling shares. You'll have to question yourself, do I want a broker that is commission free, zero commissions, zero fees, or do I mind paying a fee, commission in exchange for some more information about the company, in exchange for a better platform? That's the question you have to ask yourself. So, what brokers are out there? Well, I'll divide this into USA and Europe, because there are brokers that are targeted to USA people and there are brokers that are targeting European people. So for USA, you can use brokers like TD Ameritrade, Webull, Robinhood, Fidelity, Charles Schwab, and E-Trade, for example, just to mention a few. For European people, you have brokers like Interactive Brokers, you have Revolut, Trading 2112, eToro, and Saxo Bank, for example, just to mention a few as well. So when choosing a broker, always check their webpage for fees, the full list of fees, because there's a lot of hidden fees that people don't know about, like inactivity fees, and a lot of people ask themselves, why am I losing money when I'm not even trading? And you have to take everything into account, so always remember to check every single fee that your broker takes. So now you know what the stock market is, you know what a share is, and you know how to buy a share. But does this mean that you should just open up an account with a broker and buy the first stock, the first share that comes across the screen? No. You should ask yourself, why should I buy Apple? Why should I buy Amazon? Why should I buy Google? You always should have a strategy behind every single move you make in the stock market, and this is where investing styles come in. There are two major different styles, which are investing and trading, and the difference is in the time period between the buying and selling shares. In trading, you usually buy and sell a share in a very short period of time, while in investing, you usually take a very long period of time between buying and selling a share. Trading can be divided into multiple categories. For example, there's scalping, which is buying and selling shares in a matter of seconds to a couple minutes. There's day trading, which is buying and selling shares within the same day. And there's also swinging, which is buying and selling shares in a matter of a couple days to a couple weeks. While trading, you usually base yourself off a chart. You don't go into news, you don't analyze the financials of a company. Now, investing is hard to divide in categories, because in the end, you will have to develop your own style. What do you like to see in a company? And why would you invest in this company? At the beginning of this video, I mentioned Warren Buffett, and Warren Buffett's strategy is called value investing. Value investing is when you believe that a company is undervalued. So you think that a company's shares should be $10 per share, but they are actually $6 per share. So you buy these shares at $6 and you wait until they come up in value until the $10. There is also growth investing, which is investing in a company that you believe will expand massively or will grow hugely in the next 5 to 10 years, for example. A great example of this right now are wheat companies. Wheat companies are expected to grow massively in the next 5 to 10 years because of the changes in laws. So finally, a third strategy would be dividend investing, for example. A dividend is when a company pays back money to its investors. For example, here you see that Apple offers a dividend of 82 cents. And here you see that Amazon does not offer any dividend. So dividends are great because once you have bought the share, you don't have to do anything else, and eventually the company will pay you back money. You will make back the money you spent buying the share. So this was a very basic video made for beginners, made for newcomers to the stock market, but we've all started somewhere, we've all been there, and I hope you learned something from this video, and I hope to see you in the next video.